Hello traders, this is Rich from Tradesight. This is the market preview for the coming session. This is for Tuesday, January 7th, 2014. We had another distribution day today to start the new year. And while it was a pretty good distribution day, we didn't do a lot of technical damage internally. NASDAQ was essentially struggling all day, but the New York Stock Exchange was trying to hold course. But let's move on and take a look at the individual price patterns first, and then we'll look at the levels and some of the signals associated with those. All right, first up, here's a look at the ES futures. You can see that we're still well above the triangle breakout. We did dunk down and retest that, make a new high, but we are 3 days down now. 3 days down, we could see a little bit of buying tomorrow on the heels of that 3 days down. Have like a testing day. Oftentimes, people will start to ring things in after 3 days down, but that's just a very, very short-term thing. So for now, we definitely have a little bit of a downward bias going here, coming off of range high. The NQ side of the market is also, the Dow Jones side of the market is also 3 days down, but you can see that we don't have the same range expansion to the downside. We actually had a bit of a back and forth here the last few days, so we really haven't gotten any distance away from the top yet. We're still constructively above the breakout and above the most recent high pivot as well. All right, here's the NQ side of the market. The NQ side of the market is actually the one that's been getting the business a little bit more aggressively to the downside. We've fallen back down here below and tested the recent breakout. We actually settled right at that area, so that's going to be a really key level here going forward. About 35.17, 35.18, that area right in there is going to be pretty important to the market because that was the breakout above the prior high and this little wander up here into the year end. So let's make sure that we have that level marked off on our chart and understand the importance of it. All right, now here's the ES side of the market. Key thing to be aware of is I'm just going to real quickly recap what I talked about in the video from last week about the 913.9 being in place. Here's 9 bars up in the seeker, the momentum phase, and then we had 13 bars up, which were fairly flat but did yield that exhaustion signal, and then we did another 9 bars up on top of that. So that's a 9 and then a 13, the red 13, and then another green 9 to the upside. So the 9 to the upside is essentially a reinforcement, and oftentimes what a very, very strong market needs to put in place to really turn it to the downside. We're kind of gaining the 10 EMA here. We settled just a little bit below it today, and if we follow through below today's low to the downside, that's going to put in effect that 913.9 and activate that as a sell signal. On the Dow side, we've got a fairly similar design. As you can see, here's your 9, 13, and then a 9, and we're still above the 10 EMA. So if we click that into effect, we're going to put this 4-ace level at 1625 in play, and that could actually happen fairly rapidly if we get that follow through below the 10 EMA. Moving on to the NASDAQ side, same pattern is in play. Here's your 9 to the upside, and then the 13 up here, and then the 9 on top of that. We did settle and follow through to the downside. That's why we had more relative weakness on the NASDAQ side today, because we're already below the 10 EMA, and this is where we can start gathering some momentum to the downside. Here's the MACD. You can see we did get across to the downside. And if we do drift lower, we're going to put this 50 DMA and this 4-ace level in play. To the upside, obviously the 9 candle here at 35.94 is going to be the big level to the upside. But for now, we do remain short-term negative on the Nasdaq side. We're not short-term negative yet on the broad market side just yet. So the question is, obviously, what kind of potential does the market have to the downside? Is it poised to really roll over here, or is this just going to be something kind of garden variety? I don't think it's going to be garden variety. I do think it's going to be some kind of a meaningful move based on the pattern. The 10-day trend here is hovering well below the 1 level, so we've got all this space to go to the downside before we get up to this 1.35 area to reach anything that might be considered oversold to the downside. So there's plenty of gas in the tank to roll to the downside if the market can put it together. Starting to see some relative weakness creep into the market. We can see this evidenced by the NDX S&P cross. We're definitely being repelled by this key resistance area up here and starting to roll to the downside. We actually have a lower high confirmed now. We've got this move to the upside, this lower high here. This low was taken out by the previous move, so that lower high is confirmed. If we go to the weekly chart, you can see this a little bit more definitively when we click on the weekly chart, and you'll see how this has been a key area of resistance. We're well below the prior highs and starting to roll back down to the downside. This is certainly a negative for the overall market. Next question is going to be, are we seeing some evidence of some switching in the major asset classes? Here's a look at the Dow gold ratio. We did punch up to a new high in the ratio in favor of the Dow over the gold, before the end of the year. So right at the end of the year, as people were just kind of dressing everything up for the end of the year, this thing just kind of floated up. We're starting to see some downside here. If we break out this uptrend to the downside, this recent uptrend here, that's going to be very, very notable. I'm just going to move the regression channel, and if this breaks to the downside, we're going to be very much in trouble here if this starts to lose itself to the downside. Another risk on risk off metric is going to be the S&P TLT cross. You can see that we did top out at the end of the year. We're starting to see some negative activity in this key cross. If we take out the lower regression channel here to the downside, we're definitely going to be starting to see some risk being taken off in the market. Right now, they're essentially just probing and haven't really gotten down to business yet, but that definitely could be in the cards. All right, so here's a look at the watch list with the individual sectors ranked from best to worst. This speaks pretty loudly. Even though today wasn't a big down day, the sectors to me look very, very weak. The XAU, which is usually defensive, was top gun. Consumer staples were very high up on the list. Utilities, which are also often a safety haven, were pretty high up on the list. The bottom line, bottom sectors were the XAL, housing. Now here's where you have to get concerned. The transports were very, very weak, and the SOX, the semiconductors, and also the oil services were weaker than the overall market. So this is definitely what you would see at the beginning of something that could materialize to some more meaningful downside. So definitely keep on top of this. And we see this type of standings repeated again a couple times this week in the sector watch list. This is going to spell trouble for the market and probably lead to a little bit of a correction of some order here, which has yet to reveal itself. All right, let's start with the good news. Here's the XAU. Pretty strong on the day. This could definitely see some more upside. Right now it's just kind of gaming and grinding under the 50 DMA. We're going to be working on 9 days up, so it's probably going to need a little bit of a pause. Pretty nice little pivot here. We're obviously well above the 10 EMA, so we're short-term positive. If we clear and can sustain a breakout above the 50, we could turn to intermediate positive. Consumer staples were also fairly well traded today. I got to rescale this. This doesn't look right. We're fairly well traded today. This 8/8 level is going to be key resistance, and we're going to be 12 days up today. Last lagger was the airlines, the XAL. You can see we've got a 13 exhaustion in play. We've used the risk line a couple times, but it's still in play and hasn't been penetrated and followed through upon. So we're still short-term negative, potentially as soon as we get below the 10 EMA on the XAL. Transports had a pretty significant down day. We closed and have now followed through below the 10 EMA, so we're short-term negative in the transports. Semiconductors, weaker than the overall market. You can see we're 3 days down here. We could see some circling of the wagons here after being 3 days down, but we're probably going to wind up seeing some more downside after this little bit of a potential bounce maybe tomorrow or Wednesday. Note that we do have a negative MACD cross. Oil services, probably going to wind up going down and using the static trend line here. Once that happens, if we do release below that, we're going to put the 200 DMA, which coincides with the 2-waist level here, in play, which is probably going to be pretty painful for a lot of people because this is a big sector. All right, with the weak economic data here domestically and also abroad, we've seen a pretty sharp sell-off in oil. We did reach that 100 area. That was our target off of the 13 exhaustion buy, but we've retreated back down to almost range low on the chart, in a pretty fast manner. So if we do start to game this area, if we lose the risk level here, which is the magenta line, this is going to be pretty sloppy to the downside. So be ready for more weakness in oil if that does happen. Gold futures really starting to shape up here. We've got a double bottom in place, going back here, going back to the June lows. Double bottom with the seeker exhaustion in place. We've pivoted back above the 10 EMA, so we're short-term positive, and this is definitely something you want to keep in mind on the long side, and also keep some long ideas handy in the gold mining and precious metals stocks themselves as we go forward, certainly for the rest of this week and probably into next week as well. All right, folks, as always, thanks for listening. This has been Rich for Tradesight.